A lot to cover. So we have a lot of people who are asking us about like kind of 401k and really just kind of other investment vehicles. I was going to try to do other investment vehicles in with today. I think that there's going to be enough information without it that I don't know that it's going to be time feasible for us to cover other investments, but we might do that on another session. So, and I think that the majority of you who are on here, you guys know us already. There are some of you who are new to us, some of you who attended the seminar last week with Replace Your Mortgage that was on Replace Your Bank program. And so some of you are more familiar with us than others, but we want to be able to go through this in a way that's going to be helpful to those of you who are already working with us and those of you who are new to working with us. So hopefully this is going to be succinct enough to where it's helpful for everyone. But we have a lot of times people comparing like there's really multiple places where you can put your money. And so when you look at the different options, there's a few things that are crucial, right? You want to be able to have your money be safe relatively. Okay, so risk factor is one thing that you're looking at. Another thing that you're looking at is how liquid is it or accessible to you is it? Can you control it or who is controlling it? And then the other thing is that you want to be able to have it have a good rate of return. You want to be able to have a growth factor there. And it really kind of depends on the purpose of these funds, on what they're being used for. So for today's purpose and conversation, we're going to be talking about it from the standpoint primarily of retirement savings. And so we're going to be looking at a policy and how it compares to a 401k, for example. Now, two reasons why we're doing that. Number one is that a lot of times people are looking at these policies and they're going, okay, hang on a second, there's a little bit more of a boring rate of return, which there is. Now, at the same time, it's a boring but consistent rate of return. And so we want to tackle that first and foremost and help to understand and kind of break down that understanding. One of the things that we're taught is that in order to get ahead, we have to what? Take risk, right? So that's kind of like the thing that we're always taught. Now, one thing that we want to help people understand is that there are more than one way. There's more than one way to be able to get ahead in life. So you don't just have to take risk. That is one way, which is traditionally in the markets, and a 401k does that very well. Now, think back on, maybe not think back, but understand why 401ks started and who they are intended to benefit. Okay. Now, when you understand that, it helps you to be able to understand why it is that we're taught and educated the way that we are about 401ks, about different types of vehicles that are out there, and why we're told that we have to take risks to get ahead. Now, one thing to note is that there used to be a lot of pensions. So a lot of companies would have pensions. And I don't know if any of you guys even on here have pensions, but they're pretty obsolete. You don't really see pensions very much anymore, other than like government and state employees. And, like there are some pensions that are still out there for the most part. Most of them have switched over to a 401k kind of model because back in the 80s, 90s, that's when they started to kind of transition from kind of pension type of thing to kind of individual retirement accounts. And part of that, if you look at, like pension accounts, you see like in the movies sometimes where they'll say, hey, somebody took the pension account and they spent it, or they did risky things with it, and now the pension's no longer there. So from taking risk and shifting it from the companies, it allows you to then take the responsibility. So first of all, understand that that risk is yours. And so when they say, hey, it takes risk to get ahead, you've got to take risk in order to get a good rate of return. That's because we're taught that that's the way that you have to get ahead because that's what we have, that's what they have to offer. Now, the companies that you're doing your 401ks with, do they get a discount on their taxes by offering a 401k to you as an employee? They do. Okay. So that's why they do it. They're not doing it to try to necessarily help you. They're doing it because it gives them a tax break. Now, at the same time, because of that shift from pension to 401k, that also now puts the responsibility on your shoulders. Now, I don't know how many of you have experience in financial background, but that's one thing that we hear a lot is I have no idea how to pick these options that they're giving me. Okay. Which is one of the things that is stressful for a lot of people. I was talking to somebody yesterday, and they have an IUL, which is a policy, a life insurance policy that participates and has an index to the market. And they said, yeah, my account's not doing well. And when I asked the agent why it wasn't doing well, they said it was because of the allocations that I picked. And I had to laugh and say, well, I hate to tell you this, but no matter what allocations you pick, they're going to tell you that. And if you would have asked them which allocations I should pick, you probably picked the allocations they told you to pick. And then they're now going to come back and say you picked the wrong allocations. It was probably based on their recommendation that you pick those allocations. But nobody has a crystal ball to know what those allocations should be. Easier said than done when you look back in the rearview mirror to say, oh, I should have picked a different allocation. But chances are you're doing the same thing with your 401k packages. And so understand that it is kind of a difficult thing for most people to understand and grasp, and to understand it on the level that allows you to be able to be successful with them is pretty difficult to do. So then a lot of the 401ks then started doing these retirement target funds. And so what they'll do there is they'll kind of put together like a little bit of this, a little bit of this, and they'll have this recipe that they kind of put together for you that's kind of like a bundle of options that you're putting your money into based on your retirement date or your retirement year or retirement, 5-year window of time frame. Now, what that's intended to do is to help you to manage the risk somewhat, manage the rates of return, and kind of give you a little bit of a bundle of those things so that you're not necessarily putting everything into like a high risk category when you're supposed to be retiring next year and you don't want to have 50% of it all of a sudden go away when the market goes down. Okay. Now, I'm not here to downplay and say that 401ks are terrible. We feel like that there's a time and place for 401ks. So personally, when you're getting free money and you're getting a match from a 401k from your employer, you want to get free money. Okay. Now, aside from that, are there limitations in how much you can put into a 401k? Anybody know what the maximum is that you can put in for this year?
Think it's like 23,500.
Okay, yep. And then when you get over a certain age, then they'll also have a catch up, which means that you can actually put in more. But other than that, there's restrictions on how much you can put in. Now, really quickly, the policies that I'm going to refer to as far as the policies that we set up, I want to be very clear that the only policies that we do are whole life policies. Now, we like guarantees. We like to be able to participate in the dividends. And in order to do both of those two things, that would be a whole life policy. Now, a lot of people ask us, why don't you guys do IULs? Why don't you guys do VULs? My dad and I back in the day used to do VULs, which is basically to have participation in the market. You've got an insurance policy that also has a participation in the market option where you can pick your different bundles like you can of 401k, and you can have it be in an insurance wrapper that gives you some tax protections. The downside to those accounts is that the cost of insurance gets higher and higher every year. And then you also have the money managers that you're still paying out. And then you have those allocations of those different accounts. If the market takes a hit, your account takes a hit. So if you're funding a policy and you're putting money in and then there's a down year in the market, you can actually have your policy go bye-bye in 1 year because it went down too fast. And so, yeah, go ahead.
Just to be clear, she's talking about a variable universal life. The variable universal life policies have no bottoms, basically.
Yeah, there's no floor. There's no floor. So in other words, you can lose it all, but you can also gain it all. So if there's a 37% return, you can have 37% return actually credited to your account minus any of the fees and costs associated with that. Now, another thing to understand is that on the 401ks, or even just a regular mutual fund, stocks, any of those kinds of things, there are fees associated with that. And one of the things I debated showing you guys today, but I didn't want to have it be too insuccinct, but there's actually a good piece on that we might share at some point or do in a future training that actually talks about and gives you, like, if you put money into something, then understanding how the fees affect your growth of your like mutual fund or your stock or your 401k. So most of the time on a lot of the 401ks, you typically will have fees that are associated with it, and it ranges. It can be anywhere from 0.5% kind of on the low end all the way up to 4 and 5% on the high end. And so the numbers that I'm going to use today, I'm going to kind of split that and do like 1.5, which hopefully is kind of like a little bit more of a lower end fee. And I'm going to be comparing it to a policy. Now, the policies that we set up, like I said, they're always whole life policies because we want to participate in the dividends, which is the profitability of the company. We also like guarantees. So if you have two options, like oversimplified, you've got the markets, which are going to go up and down. Okay, and you can get your money that way, or you can have your money that's going to just give you a steady path that's going up. Which would you rather? If the dollar amount was going to be the same at the end, which path would you rather take?
The one that doesn't go up and down so I can sleep at night.
Okay, exactly. Now, the closer you get to retirement, the less risk you can take, the less risk you should take. And so if you're in your 20s and you're on here, then you can afford these roller coaster rides, and it usually will work out in your favor to be able to ride that roller coaster. And you're not necessarily looking at it every day, and so you're not losing sleep over it necessarily as a 20-year-old. The closer that you're getting to retirement, you get into your 40s, you get into your 50s, you get into your 60s, you cannot afford to take that kind of risk. You can't afford to have a 50% loss in the market and then have enough time to be able to recover. So what happened in 2008 and 2009, like that crash that happened that everybody's obviously familiar with. Now, most markets, just so you know, if you're looking at a 25-year time frame of a market, you typically will have 5 down years and 20 up years in that time frame. That's a pretty typical market. So it is very common to have more up years than you have down years. However, back in 2008, when the market started to take its crash and kind of correction, somebody who had $1 million in the account, it took them, I can't remember if it's 5 or 7 years. I'll have to look that up. I believe it was 7, but I'll use 5 just because it's more conservative. So it took at least 5, if not 7 years, if you were not taking any money out of that account, for it to have dropped and drop, and then for it to start recovering to get it back to where it was before. Now, the people that were in retirement, already in retirement or about to retire, they were the most heavily impacted by that because they weren't waiting the 5 to 7 years, whatever time frame it took for that market to correct to get back to that zero line again. And so understand that there are ways that you can mitigate that roller coaster ride. So you can either just have that boring, steady eddy growth and still get to the same spot, or you can take the volatility route. And so that's what we're going to show you today, is just like being able to kind of compare the two next to each other. So I'm going to pull up a couple pages here and I'll share my screen. And hopefully this will help to make it a little bit more succinct. And then we're going to kind of compare these next to each other too. So
while she's pulling that up, back in the day, I had my securities licenses. I had multiple licenses, and we could go in and we could take a look. Most people wanted to see mutual funds, and the mutual funds are so you put money into a mutual fund then turns around and they buy individual stocks, and they're buying and selling constantly. Those guys have to be paid. That's part of what the fees are that you're talking about in the market. Life insurance doesn't have fees. So there's no fees whatsoever, which is hard for people to understand.
well, hang on, in whole life.
In whole life, correct.
The other one does have fees. Yeah.
Okay, but in the securities world, we used to talk about what's called the Wall Street waltz, and that is 3 steps forward and 2 steps back. Now think about that. What that means is the market goes forward. It's not uncommon for the market to go forward 3 years and then it goes back for 2 years. So this is that volatility that we're talking about. And so people now then they start talking about averages. And as we've talked about before, averages don't mean anything. But people will talk about averages because people want to be able to use some sort of analysis of some way. But you really have to look at the real underlying numbers to see what's going on. So just keep that in mind. That's the volatility that we're talking about. It goes up and it goes down. And by the way, houses used to do the same thing. We've been in about the last 25 years now of markets going up, up. And people are starting to be, and those markets are starting to come down in certain areas, and they're coming down rather precipitously, is a fancy word. They're coming down pretty quickly.
That is very fancy.
I'll
Okay.
try not to get any more fancy than that.
All right. And by the way, you guys, this is interactive, so please feel free to jump in with any questions. Like if you can, raise your hand first so that way we don't have people just kind of hopping in and making comments so we can kind of get through the material. But if you can raise your hand, we'd be happy to do that. Or if you want to put it in the chat. I'm sharing my screen in a second, and so it'll be a little bit harder for me to see the chat. So if Dad and Adam, Shane, if you guys can kind of jump in, that would be helpful too.
And you raise your hand down by where your audio and your video buttons are. So it's right there. It says raise hand with a big old hand. So push that button and then we'll call on you from there. Please, if you would. Thank you.
Yeah, so you should see that like kind of on your Zoom dashboard. Now, when I share my screen, it might change your dashboard a little bit. It might move it to a different place. So feel free to locate that. Okay, So this is something that helps to be able to see kind of like what an average rate of return might be. Okay, so this is taking, and some of you guys have seen this before, but this is kind of an easy way to be able to format this. So this is taking somebody who was 40 years old, and this was using a 25-year time frame. So in this example, they're saying, okay, this person had $100,000 as a 40-year-old, and they put that into the market, and this was the rate of return that it went in actual real world time frame. Okay.
Christy,
So
I'm sorry. Can you make that a little bit bigger?
Oh,
They're
yep.
asking.
Yep.
And this is also
Absolutely.
not adding to it. This is just putting the $100,000 in and letting it go.
Mm-hmm. Yeah, very good point. Okay, is that better, you guys? Okay, so as a 40-year-old, this is assuming that the person put in 100,000. Now the rate of return that year was 2%. So that took the balance from 100,000 to 102,000. Now the next year as a 41-year-old, they didn't add any money to it, but now there was a 26% rate of return. Now, this is not assuming any fees associated with it. So this is purely just taking the numbers as if you were getting 100%. In the real world, this isn't how this necessarily goes, but this is how this would work if it was purely all accounted to the account. And so this is using those numbers. Now, the 26% rate of return now takes that 102 and adds that to it. Now we're at 128. Okay, then we've got 15%, 2%, 12%. So we've got the account that's always going up. Okay. Now, the first time we have a down year is right here when we're 50. Now we've got a 2% drop. So it went from 351 down to 344. Okay, now if you notice in here, this is a pretty common, this, if you add up how many down years there are, there's 5 of them. 1, 2, 3, 4, and then 5 right here. Okay, now all of these numbers right here, when you guys are looking at your statements from your 401k and you're going, man, I don't want to, like, why would I want to do something else? I'm getting a 15% rate of return. Okay, now notice that when they're putting that on there, that's including the rate of return of the accounts. That's not associating anything with any fees or anything like that as far as how much is actually getting credited to your specific account. That's just saying, hey, the accounts in general that you are invested in, that's what the rate of return was for that year. So those are accurate. So when you see these high rates of return, those are accurate. Okay. Now, if you look down here, this is going to tell you what the average is. And obviously you guys know from going through middle school that you have to learn the law of averages, and you basically take 25 years and you take the amount and then you divide it, and then that gives you your average. Okay. So your annual average rate of return over this 25-year period is 8%. Okay. Now, this was the real market. Now, this one over here is called an unfavorable sequence of returns. In other words, this is basically taking this data over here and it's putting it in the exact opposite order. So instead of it being in this order, they took this number and started with it and ended with this one. And so it's taking it in the exact opposite order, just to be able to illustrate the point. Now, when you do that, it's the same average annual rate of return of 8%. Because the starting amount was 100,000, the ending amount is still this 693, so therefore it's the same exact average. Do you understand that? Now, with that, do we know if it's going to do this or some combination in the middle? We have no idea what that sequence of returns risk is. So let's say that this person wants to retire when they're 60. And let's compare these two next to each other. Okay, so at 60, they could either have 916,000 in their account, or they could have 460,000 in their account. Okay, that's the risk that you're taking on. This is the roller coaster ride that we're talking about. Now, if you're patient and you do what you're supposed to, which is to leave it there, even though you have a down year, you're supposed to kind of just leave it there and trust the system. And then you've still got your 8%. You're going to kind of end up in the same thing, even if it's in a different order, in comparing these two next to each other. Okay. Now, what about when you retire? So when you retire, you hear us say this a lot. When you retire, you can't afford to have any of these losses that are happening, right? So what do most people do when they're getting close to retiring or they're in retirement?
Move to cash.
Yeah, you want to move it to cash, right? So then you kind of do a more conservative bundle within your 401k and you say, okay, I need some more bonds. I need some more cash liquid accounts. I need to be able to kind of minimize my risk. So anyway, so what I'm going to do on sampling this is I'm going to actually use this 8% as if it was a guaranteed increase amount, because that's kind of what this is here. So we've got the highest year was 34% return. The lowest year is this 38, and then everything in between there. So there's a lot of variables in there in between those. So I think that's probably a pretty fair assessment. If we're kind of like on my sheet over here, I'm going to use this 8%. Are you guys okay with that and understand why I'm using that? Okay, because I have no idea what the markets are going to do. So I'm going to just use this 8%. Okay. All right, so here's what I'm doing. I'm kind of pretending that this person, this family, that they have income of $150,000 a year, and that they're putting aside 10% of their income. First of all, is 10% enough to be saving for most people? Okay, it's not. So most of the time, the recommendation, if you are in your 20s and you're starting off and now you're saving and you're going to be in a good habit always, 10% is probably fine. Now, 10% of your gross income, notice that, by the way. So this is not going to be this person saving enough, but I'm still going to use that number just because I've already sampled it out, okay? Now, on 10%, if you're in your 20s, that's fine. If you're in your 30s, you're needing to probably add about 5% for every decade that you're waiting to start saving, and depending on what you already have saved up, okay? So if you're in your 30s and 40s, most of the time doing 15 to 20%, so 25%. So sometimes people are needing to save 30 and 35% of their income if they either didn't save it, or they maybe saved it and then they took the risk or had to dip into their 401k, and then now they're having to start over again. So understand that there's a cost to waiting, and we'll talk about that on another session too. Any questions, by the way? I feel like I'm just talking, so I don't want this to be only me talking. So
Just based off of the questions, one question was, how does whole life make money without changing fees? But we'll get to that. But they're just shocked that the average market return really does not mean absolutely anything financially.
It really doesn't. So if you're taking a boring steady course versus taking the volatile course, you're kind of ending up resulting in the same thing. So that's what we want to show you today. Okay. So I'm taking somebody who I'm kind of just fictitiously bringing in a 47-year-old and saying, okay, I've got a 47-year-old and they're putting in $15,000 a year. And then I'm having them do that until they're 64. Now, in this case, what I'm using is I'm using an 8% rate of return. And again, it's because I have no idea what to actually use. Now, just so you guys know, we do have the ability in the software to look at market history. So if you want us to sample market history, we can do it that way. But past performance is no indication of future. And so it's really anybody's guess and gamble. So I'm going to put in 8%. And then I told you before that on the fees, I'm going to actually use 1.5%. Now, by the way, oh yeah, go ahead, Dad.
Hold that thought for just 1 second. So when Christy says that past performance is no indication of future results, by law, when I had my securities license, we had to say that over and over and over and over again. But you know what people heard? They didn't hear that. They looked at the statement, and they'll say, if you ask people how much they're getting in their 401k, they'll tell you, I'm getting 12%. No, they're not. People will say that, and they'll relate to averages, but average again doesn't mean anything. It doesn't mean anything. You really have to look at the markets, and the markets giveth and the market taketh away, and there's not an advisor on the planet that can tell you what the markets are going to do. They just can't. So
but later they'll tell you picked the wrong bundle.
Yes.
Because that was up to you. That's the funny thing. So anyway.
Go ahead.
Okay, so I'm going to use 1.5%. Now, just so that you know, automatically, whatever the fees are, that means that whatever the rate of return was for that year, if you took the fees out of it, then that would tell you what the net return potentially would be on that particular account. So whether you're talking mutual funds, bonds, stocks, whatever, you can Google it. And you can actually pull up, like if you have it with Fidelity or Schwab or Vanguard or whoever you have, you can actually look up and see how to check what the fees are associated with any of your accounts, because there's management fees. Anyway, they have like several different types of fees. And so you have the easy to find fees, and then you have the hidden fees. Okay, so if you're not sure what your fees are for your particular account, that might be good practice for you to just kind of Google it and see how to find what all of the fees are and how to uncover that with your specific type of account, whether it's Empower, Empower, Vanguard, whoever it is that you have your accounts with. Okay, so if you take 8% and then 1.5 is their fee, that means that your actual net return on this is potentially actually 6.5%. So just so you know, I'm kind of using this as kind of a guideline. Now I'm putting tax rate associated with it. So I'm kind of just using this fictitious person. If they were making 150,000 a year, this would be their federal tax bracket. And I'm keeping this tax bracket the same now, and then I also have it on there for always. Okay. Now, I don't know about you, but this is the same kind of thing. What are taxes going to be in the future? So I don't know what to put either. So just so you know, that's the assumption that I'm making, is that the taxes are going to be the same. I think they're more likely to go up than they are to go down. But for the sake of comparing, I'm going to assume that they just stay what they are right now. Now, one of the other things that we're taught is that when we retire, we're somehow going to need less money. And so therefore, we're going to be in a lower tax bracket. So after we're done with this, remind me and I'll show you what that looks like if the tax bracket was lower. And if you really think that that's going to happen, then that's fine. I will show that to you so that way you have that as a comparison. But for right now, I'm just going to assume that the tax bracket is never going to go up and it's going to always stay the same. So it's a little bit going to be unfair to the policy, but I'm okay with that because it's still going to outperform it. Okay, so I'm having this person put into it, and we've got, okay, so we've got the end of this. Now I'm saying that this person's going to retire at 65. Okay, you guys have probably heard me say this, but one of the things that I'm taking this rate of return when you retire. Actually, I just realized I didn't change that. And I'm saying that when you retire, you're going to now take on less risk. You're going to be doing a little bit more boring but consistent returns because you want to preserve it and you don't want to have it do that volatility dance that it did up here. Okay, so you're okay to take it to a degree, but then you're going to want to be more conservative. Go ahead, Dad.
So why would you go from 8% down to 4%? If you've been making 8% all along, why wouldn't you stay at 8%? There's more risk at 8% than there is at 4%. So when you're at 65, you can't afford to take risk. When you're 25, you can afford to take risk. But when you're 65, you're too close. I mean, it reminds me of when I was learning how to fly. And when you're flying an airplane, the airplane goes through what they call a stall. And that has nothing to do with the motor. It has to do with the wings not giving you enough lift. And so as to overcome a stall, what you have to do is put your nose down, which is exactly counterintuitive. Now listen carefully. You have to put your nose down to pick up airspeed and so that you don't fall out of the sky. So you put your nose down. Well, you can do that if you're at 50,000 or 30,000 feet. If you're at 20,000 feet and the ground is at 8,000 feet, you don't have enough time to recover, and that'll kill you. So you cannot take risk. You should, when you're ready to retire, if you don't turn down your assumptions and start putting money in more risk averse accounts, you could lose it all. And by the way, if you've been saving for 30 years and you're used to looking for higher rates of, I mean, how old was Ray? My 90, I guess he was 85-year-old father-in-law had been investing all of his life, and he could not think of anything else but investing. So the idea of starting to take money out, he couldn't do it. He just couldn't do it. He just, he just had to keep finding the great investments. So guess what? He got into some really stupid investments, and it cost him dearly. So that's why when Christy's saying that we're going to lower the rate of return, you need to, because if you keep trying to take money out at 8%, and this goes against what Dave Ramsey says. Dave Ramsey got just real crosswise with the financial world when he was using his analogy or using his formula. And basically I was sucked into this too. If you're making a 12% return, why can't you take out 10? You're not making a 12%. You're averaging 12%. And again, average is not the same thing as actual. Little tirade there. Sorry.
No, you're good. I just realized that gave me a chance. On my policy illustration, I had 1 extra year, so I want it to be fair, and I'm gonna readjust this here. Okay, so this is putting into it. I'm actually gonna add this row to it so that you guys can see how many years it is. Okay, so this is assuming that this person's putting in 15,000 a year for 19 years. And that takes them to 64. And then in the 20th year, then they're now 65. Okay, now you guys have heard me say this before. How much can you take out of this 539,000 that you've got in this account now?
So by the way, BOY stands beginning of the year and EOY is end of the year. That's what those numbers are. What those.
Yeah, thank you. So this is, yeah, the beginning of the year, you got 526. So I'm kind of assuming that, okay, now you're 64. Now you're going to retire at the magical age of 65. So now at the end of the year, we've got $559,000 in this 401k account. Okay, so how much can you take out to make sure it's going to last you? Okay, now you guys have heard me say this before, that the magical number for a long time was 4%. So I'm going to show this to you. So 4% of 559,000 times 4% is 22,394. Okay, so I'm going to use that number just so you guys can see. So 22,394, 52 cents. It's not going to let me put in the cents. Hopefully you guys are okay with that. And I'm going to have that. I'm going to try to have it last me 30 years, and I'm going to inflate that at 3% so it has it going up with inflation. Okay. Any guess on when this will last you? Do you think it'll last you 30 years?
I do. I think it will.
You run out at 88.
Time to go back to work.
Yep. Hello,
What?
Walmart. Okay. So
Welcome to Walmart.
when I say it's not going to last you by taking out 4%, this is kind of what the financial planners are realizing, that, hey, we've been telling people take out 4%. Well, if you're reducing your risk, which you should be doing, you can't afford to do that. And so you've got to be able to like lessen that. Okay. Now I've already done this. And so I'll kind of spoiler alert it. I went down to 3.5%. It still didn't last. So I did 3.25. So I kind of made myself a little cheat sheet. So I'm going to assume we're going to use 3.25% of the prior year's balance. And then we're going to do a 3% increase every year, because you don't want to run out of money. Now, I don't know if you know when you're going to expire, when you're going to pass on to the next life, but you want to make sure that your money's going to outlast you. So I'm going to take this balance, this 559, and I'm going to do 3.25%. You guys will see how long that lasts. 559.
And by the way, everybody has a different expiration date. I mean, we joke about this when we talked to you originally. I said, take off your shoes, look at the bottom of your foot and tell me what your expiration date is. We joke about that because everybody's life expectancy is different. And you don't know what that is. That's the wild card that the financial world doesn't really like to deal with. They really have no way of dealing with it, except saying, well, you better not spend as much. Well, how many of you, I mean, if you had $1 million and you could only take out 4%, how much is 4% of $1 million? $40,000 a year. And then you have to pay taxes on that if it was in a qualified plan. The numbers become absolutely unbearable. And you can get really depressed over that whole thing if you leave it in the hands of the investment world. The investment world doesn't have a solution to that.
Well, and in a lot of cases too, one of the ways that you're going to want to do that, like even 401k policy, whatever, wherever your funds are, give yourself more time than what you think you're going to need, because you don't want to run. And so if you're pacing yourself and give yourself an extra 5 or 10 years above and beyond what you think your life expectancy will be, then that's one way to help to ensure that you haven't. Now, if you're in volatile accounts, even the best planner, if you can't plan for a market downturn. So you're better off to preserve the capital that you have and get a boring return than to try to risk it and have the volatility and have it go down by too much and not be able to recover it. My dad has a good rule of thumb that I'm sure you've probably learned from somewhere else, even Dad, but that basically says the amount of risk that you should take is about 10% of your net worth, and try to have that be your risk tolerance, because anything more than that, you can't afford. If you can't afford to lose it, you can't afford to invest it. So just be careful with that, because we see people taking on too much risk and they don't need to, and there is a better way. Okay, so on this, if we're taking out 18,195 and then inflating it 3% every year, then that's what this number is. This spendable number here, right next to it, is actually what you're left to spend after the taxes are taken out. Okay, so this is what's spendable to you. This is what you're actually taking out of the account. This is what you have to spend. So now I asked you guys to kind of guess on how long this will last. Okay, so this is taking out 3.25 and it still lasts until 93, not quite. So when you hear us talking about like that, depending on how long you plan to live, you can take out anywhere from, the new number is kind of like 3.8% up to like 3.5%, up to 4%, again, depending on how long you plan on living. If you find out that you've got cancer and you have a short life expectancy, feel free to spend that down much faster. But otherwise, you probably need to make sure that you're having that last you, well into your 90s, because you don't know how long you're going to live and you don't want to run out of money in case you do live that long. So I'm going to still use this number even though we run out at 93. I'm going to still compare it next to a policy because it's more fun. Okay, so this is this route. Now, if the tax rate does go down, let's say that this goes down to 20%, then guess what? That might last you longer, or it will last you longer because you're not going to lose as much to taxes. So you still have, then you'd have more in this account to spend. So I still kept this same amount in here, but then that would take it out longer if the tax bracket did go down. So hopefully you guys are lucky and that's what happens, but I don't think that's likely to be the case. Now, if the opposite happens and the tax rates go up by 1%, 23%, let's say, then that means that you're running out of money sooner. So we've got less in the 93rd year, and hang on one second, where did that go? That did not account for it, hang on. Dang it, that messed with my numbers. This isn't recalculating, it's still saying, well, it's got the balance at the end. Oh, I'm sorry, this is spendable cumulative, I'm sorry, you guys, yeah. So we ran out at 93, so we've got 0 at the beginning of the year, 0 at the end of the year. So it has a little bit lower number, still lasting till 93. So again, it just depends on what the taxes are going to do, but who knows? But if you have market volatility and then you have tax volatility, you're kind of giving yourself 2 heart attacks in one by not knowing how long that's going to last you. Okay. All right. Any questions, you guys, on this part? Otherwise, I'm going to switch to the policy and show that to you. Okay.
So what you'll notice real quick, Christy, is the taxes are probably a bigger factor as far as unknowns, right? It's also funny too. I always mention this to people. We're fans of Roth IRAs to an extent. We feel like those are the best qualified plans because it's post-tax. So you're putting money into those after tax. You don't have to worry about tax in the future. But it's funny how the government limits people significantly to what they can put into those. And if you make too much money, you don't even qualify to fund those. So, what Christy's going to go into when she shows you the policies is we're pretty much factoring out that tax problem, and they give you the ability to put in more than what you can with a Roth IRA too. So, but it's just funny how the government limits you on the best plan that they offer.
Right, which is no surprise because they want to make sure that you're taking your money out, which is why they'll penalize you 10% by taking it out before 59.5, but they'll also penalize you if you haven't taken it out by the time I think it's 73 is the new RMD age. It depends on your age or when you were born, but sometimes it was 72, 73, 74, somewhere right in there as far as when you're required to start taking your distributions, or there's a 50% penalty. Because they don't want you just leaving it here. They want to make sure that, hey, we're okay to defer the tax because we're okay with that being a much larger amount for us, but we want to make sure that you pay it to us. So that's why those RMDs are on there. Okay, so you've got this that's kind of giving you that mixed return, which I kind of just put it in here as if it's a set return. I'm going to take you to the policy. Now we have multiple companies that we work with, but obviously we've got some favorites. And so this is a particular company, and I'm kind of purposefully not putting the company in here because it doesn't necessarily matter. They are all pretty similar to each other. So this is assuming that the person's putting in $15,000 for the same time frame. So we've got that going in until 64. So I want you to see like the row and age and everything else so that you see that we're kind of trying to do apples to apples there. So if you've got 15,000 you have going in, Now, this cash surrender value, every policy has a surrender value. In other words, an amount that you have access to. We also call this a life insurance line of credit, or what's available to you. So you have access to this. Now, coming back over to the 401k, what do you have access to as this is growing?
Depends on the carrier. Sometimes you can get a loan. Sometimes the previous employer I worked for, they wouldn't even allow loans. So there was
Oh,
no
really?
access. Nope.
Okay. So usually if they allow a loan, then you're maxed out at 50,000, and they usually will only allow you to do one at a time. On occasion, I've seen somebody who like government employees, state employees, sometimes they allow you to take more than one loan at a time, but they will also limit you to 50,000 being the maximum if they allow it. And then they also will have a required payment and interest rate. And so the guy that I talked to yesterday, he had the choice depending on what he was using it for, but he also had like a 3-year or a 5-year time frame. If he was using it for home purposes, he actually had like a 15 or a 20-year time frame, which I've never seen that before. Usually it's more common for them to schedule it out for a 3-year repayment or a 5-year repayment, and then they'll take it out of your check. So you are limited on your access before 59 and a half. And if you're taking a loan, then you're basically taking it out of rotation and then kind of giving yourself the ability to be able to use it and then have to go back within 3 years or 5 years. Okay, policy side. We're going to focus the rest of the time on this. Okay, on the policy side, you have the cash surrender value, which is again what you have access to be able to utilize. So you can take this, like in the first year, you've got 11,000 of the 15,000 that's going into cash value. So where does the rest of what you put in go if it's not showing up in cash value? Death benefit. Okay, so every time you put premium in and a contribution in on a policy, it's going to automatically go to 2 places. It's going to go to cash value and it's going to go to death benefit. Now, the second year, we're going to do the same thing. So this is a cumulative cash surrender value, just like what we saw on the other page on like the IRA or the 401k, I mean. And so this is what you've got access to. Now, in this case, the insurance company is going to give you access to 95% of whatever you have in cash value to be able to have that as a loan. So if you do want to use it, it's unstructured loan repayments. We're not going to talk about that today. We're going to look just at contributing and pretending like we never use these funds for anything. In real life, you would use these to help you pay off your house faster, your car faster, finance your kids going to college, whatever it is that you're wanting to use it for. Our recommendation is to be able to borrow it, but make sure that you put it back so that way you can use it again in retirement. If you don't put it back, you're just robbing from your retirement account. No different than if you were to borrow it from your 401k and then say, okay, never mind, I'm not going to pay that back. Then it wouldn't give you credit for that. It won't do some magic thing with the policy either. If you don't pay back a policy loan, you're not going to be able to take the income off of something that you never replenished and put back. Okay, so this case, I'm taking it out. Now, I told the software in the system to tell us how much we could take out, and I told it that I wanted it to last for 30 years. So I'm starting at 65, and I'm actually taking it out for 30 years, which means that I'm also taking it through age 94. Okay, so we're having 1 year longer than what you just saw on the 401k. And do you guys remember what your spendable income starting on the 401k was?
14 range, 14,000 range.
Okay, so which is higher, 14 or 15? We've got higher income here, and it also lasted 1 year longer. Okay, now here's another thing. What about death benefit? So on this one, we called it estate, I think is what it's called, estate value. So what this number is representing is, hey, if you passed away, what would your estate get? Now, this is assuming that this 23% or whatever percentage, let me change that back to 20%, 22, sorry. Let me change that back. So this is basically assuming that the taxes are your taxes. If your kids inherit your IRA, let's say that you pass away at 75, or not 75, that's too early. Let's say you pass away at 85 or 82, because that's the bottom of my page. So whatever you have in ending value, 334,406, who's going to inherit your 401k?
Hopefully your spouse.
Hopefully your spouse. Now, if it's your spouse, they can take this 334, they can roll it into their 401k, which means that the RMDs are still there, because then the IRS is going to make sure that they get their money. So if it's a spouse, you can roll this over. If it's not a spouse and it's your kids that inherit it, whose tax bracket are they going off of, yours or theirs?
The kids.
Okay, they're going off of the kids. Are the kids going to likely be in a 22% tax bracket or a higher tax bracket?
Higher, because they're in their best earning years.
Okay, now here's the other problem. They also have a time clock. As of right now, like if they inherited this right now from you and it was a kid, then they have a 10-year window to get this out. Okay, what is that going to do to their tax burden? It's going to probably jump them into the next higher tax bracket. So even if they were in a 22% miraculously with their own income, it's going to end up putting them into another higher tax bracket because they have to get it out of there in a 10-year time frame. You see why the IRS benefits and not us? So when I said before, you have to understand the rules of it because it helps you to be able to see like the players of it and how this relates. Okay. Now on the policy side, we then told it, hey, we want to spend down our cash value and get as close to $1 as you're going to let us get. And we're also going to be dwindling down our death benefit when we're spending down our income. But we also want to make sure that there's always a death benefit that's present. So in this case, I said, give us as much as we can on a withdrawal, but then we also want to make sure that we have death benefit that's always going to be there. So this death benefit, I only took it out to age 99. Sorry, I should have actually gone out further. But just as a spoiler alert, this will actually take your death benefit out to age 121 so that there will always be a death benefit no matter when you pass away along the way. So that helps you to be able to see what the spendability of things are. So when we talk about how, you can get the rate of return and you can take the volatility route and go the 401k route. You can also go the steady Eddie consistent route, which is a more boring return, but it also gives you access to be able to use the cash value that is building in the policy in the meantime, so that if you're wanting to use this to help you to refinance higher interest debt or finance things yourself, you have a pool of funds to be able to do that. So that's a whole nother side amount that you can actually utilize to be able to help save you money in interest. So everything that we're doing, we want to be able to help you to save money in taxes. We want to be able to save you money in interest that is lost to you. Now,
Hey, Christy.
Yeah.
Deanna has a question for you.
Yeah, because you were talking about in the other one, the 401k with the estate, it's by the taxes. This one, their death benefit, there isn't a tax on that, right?
Exactly.
To your kids. So there's no death benefit. Plus, the reason that I'm just going to say this out loud, I'm pretty sure I got it. The reason that we have to have a death benefit is so we don't trigger a tax. Is that right?
Yeah, the policies are set up so that they're tax advantaged. And actually, the insurance company now changed the wording that they want us to use, and that they're taxed appropriately. Isn't that funny? Okay, so what that means is that we're building it and designing it in a way that allows it to grow technically tax deferred. And then the way that we have it set up, it's going to come out tax free. So it's taxed appropriately. There you go. There's your blanket term on how they want us to say that. So not all whole life policies are set up this way. You do need to have it be set up specifically and designed for that. But yes, absolutely. So the insurance companies, they follow the rules and guidelines of the IRS, which basically says if you want the tax protections that a life insurance policy has, these are the rules of the game, which means that you have to have a certain percentage and amount of death benefit that is more than the cash value that you have in a policy. So, which means that you can never collapse a policy. In other words, you can never have the death benefit and the cash value go away while you're living, or it would create a taxable event. So when we're taking money out of the policy, we're taking it up to the threshold and saying, okay, how much can we take out while keeping the policy in place, always making sure that a death benefit is going to stay in force all the way up until age 121. And then also being able to pull out the money and be able to enjoy it with our family as living benefits and have the tax protections of it to be able to pull that out tax-free. And then whatever is left is the death benefit that when we pass on, that's what's actually going to go to our family, and that is also tax-free. Okay.
And then in this illustration right here, your growth is actually the percentage because of you don't have to consider the tax,
Right.
the tax factor. And then you're going to talk about fees or whatever. But
I
anyhow,
was
that's
going to say, yeah, let me kind of cover that on fees, since that's a question that came up and we were talking about that. Like, I mean, with everything, there is a fee and a cost. Like, there's going to be somebody that's needing to plan and administrate this and everything else. So what are the fees with a life insurance policy? Okay. Now I want to back up for a second. Variable universal life policies, index universal life policies, the fees and charges increase because as the values go up, then they've got to pay the people who are managing those accounts. They've got to pay for like the cost of insurance, and the cost of insurance is going up. On a whole life policy, which is the only type that we do, the fees and costs are already built in, which is basically what is helping to cover your death benefit. There are no other fees. The fees do not go up. The cost of insurance does not go up ever. Okay, so it stays the same always. So there is no such thing as, oh, an increasing fee or it's an increasing cost of insurance. It is what it is, which is already accounted for in the cost of the death benefit. It's already built in. So that's a good question. So as far as like what you're getting versus what you're splitting, it's already accounted for here. So yeah, good question. Okay, any other questions on that?
I will say this too, just so people are aware, depending on how the advisor designs your policy will determine how much your cash surrender value is. So if an
Absolutely.
advisor designed it improperly, right, your cash surrender value in the first year could be as low as zero. So
Oh, absolutely.
that could be considered a fee. So you got to be really careful with who's setting these up for you. So that's another
Actually,
way.
yeah, Adam, I'm glad you said that. So one of the things that you should be looking at and how you would know if you have one of these policies, like if you have a whole life policy and you're like, I think it's well designed, there is a way to double check it. So,
Hmm.
and partly this is going to depend on age and health, but for the most part, if you look at how much you have put into something,
The C
and then
stands for
when
the C stands for cumulative.
So this is saying like this is the premium right here. This is cumulative premium. So this is kind of taking everything that you've put into it up until this point. So in an ideal world, we want to be able to see, and again, sometimes with age, we might see this happen by like year 9, but for most people, this is usually happening by year 7. This is on a 46-year-old, and so it's actually happening by year 6 on the amount that was put into it versus the cash surrender value. Those are equal to each other right here. This is actually higher than this number that you put into it by the 6th year. If it is longer than the 9th year, then chances are, and you're healthy and you're below age 65, then chances are we can improve that and do what's called a 1035 exchange to be able to take the policy, move it over to a better vehicle, and allow you to be able to have more growth on this. So we want to be able to see this happen. You know, usually this is happening for most people that we set up. It's usually happening by the 7th year. So if it's any slower than that, if you're looking at how much you've put into your policy and you're like, hey, I've put in $100,000 and my policy cash value is only $72,000. By the way, those of you who have an IUL, I'll challenge you to do the same thing. Look at how much you've put into it,
Yeah.
because I promise you this whole life policy that we design is probably better than your IUL that you thought you were going to get a better rate of return on because you took the market participation. And even though the last 10 years have been all good year markets, I'll bet you dollars to dimes that we would outperform that even on our boring whole life policy. That's the crazy thing. And we'll actually have to do that for another training call, just do like a whole life versus an IUL, because
Yeah.
that is a whole nother can of worms that we can kind of go into. So anyway, hopefully this has been helpful to you guys. We've got a couple minutes left, so I'm happy to stay on and answer any other questions that you guys have. But this should help you to be able to see that you can kind of take 2 routes. You can either take the boring steady Eddie route and kind of have, you know, likely a better scenario and outcome, better tax situation for your kids, better estate value, better usability, spendability. You have access to the funds that are in the policy 30 days after you start the policy, so there's not like this big long wait that people think that there is. Normal traditional whole life policies, it does take a long time before you actually start building cash value. The way that we do it, you're getting that from day 1. you're not having to wait, and there's no such thing as accumulated value versus surrender value. In other words, they're not saying, hey, we're trapping and having a surrender time frame or a surrender fee. That doesn't exist either on whole life policies.
I have a question.
Mhm.
Now, just so you know, I'm getting like solicited from a lot of other companies that want to take me, you know, to do that. So now that you mentioned like a 1035 exchange to me, that's probably what they're trying to do. Is can you do a 1035 exchange and roll one of your policy, if you have two policies, roll one of them into the same, into the one, just have one big policy?
You can, but you can only do that at the start of a policy. So you can't take one policy and roll it into an existing policy, but you can roll one policy into a new policy.
Or two policies into one
Or
policy.
two policies into one. Yeah, I think the most we've done is three or four policies into one, but yes, you can do that.
And just to kind of give yourself a little bit of a pat on the back, when I start telling them already what I know about all this stuff, well, you might not know, you know, I'm like, oh, yeah, I have paid up additions for that, you know. I told them that I've learned it from here, and that you guys want your clients to be educated. And then one of them said that, shoot, you could have a you could teach some of this stuff. Oh no, don't give me that far. But it was a very good compliment to you. Because one of the things that he had talked about, he had insured his children. I told him that I was using it for infinity banking. Oh, that's where we started talking about it. And he had his kids, and I said, how many kids do you have? You have all of them insured? You know? Yes, he does. He goes, oh, you see, you knew. I said, yep, I knew that. And I give you guys the credit. All right, I'm gonna have to bounce, you guys.
Okay,
I'll see y'all next week. Bye-bye.
Yeah.
Thank you.
Bye.
All right, and those of you who are new to joining us, you probably saw the webinar that we did last weekish. Man, that seems like forever ago, and yesterday all at the same time. So you should have a link to do a discovery call with us, or if you already have that set up, then we look forward to meeting with you. If you don't have that set up yet, feel free to let us know. We can send the link out. Actually, I can even probably just put it on here.
I've got it, Christy.
Second. Okay, thank you.
Mhm.
So
one thing too for new people, you know, these insurance policies, it's not an either or. We're not saying that you should only do one or the other. In fact, you know, we can show you how to make two work off of each other. You know, Christy has showed me a few years ago in the software, you can look at how if you have a 401k or a market correlated account and a policy, you can work those two together so that you can actually spend more money. So again, it's not an either or. A lot of people refer to the policies as an and asset. So a lot of people get tripped on that, like, oh, I should only be doing this or only should be doing that. Not necessarily. So,
Christy, can you bring up that sequence of returns piece again you had?
mm-hmm.
Let's talk about this just for a second, picking up on what Adam just said.
Well, and really quickly too, while I'm pulling this up, the reality is, like, when you get to retirement age, you kind of have a choice. Do I want to leave it in the markets? That might also be the time to then shift it over into the policies. So it's not a bad place to be accumulating things. You know, maybe you want to accumulate some of it there, some of it in the policy, but then when you retire, you might want to start shifting from the tax deferred account over into the policy. Most of our clients, that's actually the plan and the process, is what we call it dripping out, which means that, you know, you might stop funding it from your personal income at some point, but then have it be funded from what you're trying to shift over from a tax deferred account over into a place that's going to make it more spendable. So now some people will take that to mean that, okay, well, I'll just accumulate it in the 401k and then I'll get a policy later. It's ideal to start one before you retire because you already have the built-in, you know, age, and you've already got it established and you've got it up and going. So that's the better way to do it, is to have a policy already up and going. Although we do have people that do start a policy with us when they're 65, 70, and then they're just trying to shift their assets over. That's okay too, but it is going to give you a better bang for your buck to have already had the policy started before you start shifting it over, in an ideal world. But we can do it either way.
So, Christy, if you move your cursor down there on the 55th and 56th year on the left-hand side. Okay, see that in the 55th year, The year before that, the market went up by 20%, which is a good thing. Not both sides, just look on the left side for just right now. So on the left side, the market went up 20% that year to 1,106,000, which is a good thing. Now, if you're taking money out, if you're putting money in, this is a good time to be buying. This is what dollar cost averaging is really all about, because you're buying when the market is down, and if you're putting the same amount of money into your 401k each week or each month, you're buying when the market is down. That's great. But when you're coming out of a variable account, and the market drops by 10%, and you're taking money out, and then you're taking money out the next year again, and the next year again, you will run out of money.
Yeah.
There's not a
Fast.
question about it. You will run out of money. So if you would, let's say that you retired when you were 55 and you took money out and the market dropped by 10%, the next year, instead of taking money from that account, what if you had an account? Think about it. What if you had an account that was guaranteed to grow every year? Couldn't you take money out of that account when you're 56 and when you're 57 and when you're 58 and then start going to and let that account rebuild again, because it'll regenerate.
Yep.
Okay, that regeneration is really important. And so we're not saying have only a life insurance policy. Likewise, we're not saying have only a whole life. I mean, have a 401k. The two together work very, very nicely together.
Them
They
play off
really
of
do.
each other.
They benefit. Now let's talk about the pension real quickly. If you have a pension, who's putting money into your pension?
Mhm.
The employer. Who's managing it? Not you. That's being managed for you. So you don't have to think about it. So these things actually got started originally in the 1970s when a guy by the name of oh gosh, all of a sudden I lost his mind. Ralph Nader. There we go. Ralph Nader. That was the age when people were starting to, that was the consumerism. He talked about consumers. And that's when this whole thing got started, when people were saying, I can do a better job of managing my account than these crazy pensions. Well, then the companies basically said, okay, we'll take that away from you, which they did, and we'll give you the opportunity to manage it yourself. The problem is that 95% or more than that of the population are not investors. They don't know how to look at a prospectus of a mutual fund and tell you anything about. I mean, those prospecti, proper language, those prospecti are 100 pages or more, and you're supposed to go through and make sense out of that. You don't have that kind of education skill. But people said, well, I can do that. Well, I've got my investment advisor to figure that out. Well, guess what? He doesn't have that time either. The things have gotten so complicated now, but it's very difficult to do that. But anyway, the two together, life insurance gives you guarantees. The securities gives you possibilities. But there's a difference between guarantees and possibilities. But the two together can work rather nicely together.
Yeah.
Well, and if you've got both, then what does that do to your overall tax bracket too? So like using that example, if you had, whatever it was, 14,000 that you were taking out of the 401k, and then you were taking 15,000 out from the policy, that's 30,000 between the two of those essentially, right? And so then what are you actually taxed on? So by being able to have this, it helps to lower your taxes on everything else that you have that's taxable, like if it's tax deferred. And like Adam was saying before too, like with a Roth IRA, so again, it's not about not taking risk, it's about understanding it and understanding that there's multiple ways to do it. So there isn't just the markets, there's also like just the steady Eddie accounts. And so being able to see them next to each other hopefully helps you to be able to see that, so that you feel more empowered and feel like that you have more of a choice, and not feel like that the markets are the only way to go, because there really are other ways that you can actually get potentially a higher return and not necessarily have to take the risk. So 401ks are decent. Roth 401k, if you have the choice between doing a Roth and a traditional with your work, do the Roth, because then at least you're taking out the tax unknown. You still have the volatility of the market, which you can kind of pick your allocations, but at least you're taking the tax component out of it. The two biggest threats to our money are markets and taxes. And so if you can take one of those out, then that helps you.